Hello students. Now let's practice the price and the quantity variances of direct material cost and direct labor cost with this flexible budget variances. Okay, this flexible budget variances is comprised of two main parts, the price variance and the quantity variances. So the price variance in production is equal to the actual price per unit minus the standard price per unit. So the variances of this price per unit times actual quantity used. Quantity variance is in production is equal to actual quantity used minus standard quantity for actual output, which is the variance of the quantity times the standard price per unit, so that we can get this the quantity of the variances. Okay, let's go to the practice here. Okay, the Hill Fine Instruments manufactures trumpets, trombones, the tubas, and other brass instruments. During April, Hill scheduled 550 trumpets for production. However, the company produced only 525, so we are going to use these 525 for the outputs. Hill purchased and used 6 pounds per unit for direct materials at a unit price of $9 per pound. It used 11 hours per unit for direct labor at an actual rate of $26 per hour. The following standards and actuals were developed for the line of trumpets. Now let's calculate it. As you can see that we have the actual price and quantity information and the standard price and quantity information. And then the first process is to get this actual quantity used for the actual output level of 525, because when we calculate this, the actual, the flexible budget direct cost variances, we need to know this actual quantity used for actual output level, and the quantity, actual quantity, and the standard quantity. But it shows only the price per unit and the quantity per unit basis. So we need to articulate this, the table information into this data one. Okay. Actual quantity used for the actual output level. How do you calculate it? Now we use this material information, okay, about the quantity. Now we need to get the quantity information. The quantity 6 pounds used for one trumpet times how many? Right, the 525 units. So the total materials, the actual quantity used for the actual output level is 3,150. In the same way, the labor also, we use this hour, the quantity, hours per unit, how many units? 525, okay? In the same way, here in the standard information, standard quantity per unit, we expected a 5 pounds. 5 pounds times not planned production, but we need to use this actual production. So in total we have 2,625 in total pounds when we expected this the standard quantity. And then the total labor hours is also 10 times 525. So we got the total the quantity in each the quantity level in each in the actual quantity used for actual output level and the standard quantity in the same level. Now, how do you get the flexible budget direct cost variances? It is just simply we can calculate the material cost. How to get the material cost in actual? So actual cost per pound. Actual cost per pound times. Now what do we need? There we go. The reason why we calculate this, the actual quantity, is that we use this function, actual price per unit and actual quantity used for the actual output level. Okay, So, oh, that is the material cost. Material cost is now should be subtracted by now the standard level. Where is the standard level? There you go. The $10 standard price per pound times now what we calculated for this the variances for the direct material cost is 2,625. So 2,100 is the variances. 2,100 is the variances. So we have the positive number. Positive number means that the actual direct material cost is greater than our plan. So by $2,100 is unfavorable. In the same way, the labor cost. How do you calculate this labor cost? Now we use the actual rate per hour times actual labor in total hours, the actual quantity, right? And then we use this 25, the standard rate per hour in labor times what we calculated was the labor in total hours in standard, our expectation. Oh, sorry, 25 times 5,250. So the labor cost, the direct labor cost variance is 18,900. With unfavorable, they spend more labor cost. So we want to know, is this unfavorable result coming from price variances or efficiency variances? The spending variances or efficiency variances, volume variances. So let's calculate the price variances. How do we calculate price variances? Now I want to use this price variances, ABS. Now, now do you see the actual cost per pound was 9, but the standard price per pound is $10. So 9 minus 10. So as you can see that the actual price in material cost is lower. So the company actually spend a less amount of money than times where is the actual quantity used for actual the output level. There you go, 3,150. So this 3,150, so 3,150 is now, that is the favorable. Again, why? Because $9 per one unit, per pound is lower than the standard price. Okay. Then direct labor quantity or efficiency, how do you calculate it? The same way. Now we use this ABS. The difference, the actual quantity of this, and then material cost, material pound, total pound. We are calculating the variance quantity, 3,150 and 2,625. Actually, we used the more pound, that is the unfavorable, and then times. Now, what we need is standard price per pound here, right? So we got 5,250, which is unfavorable. So we found out this unfavorable result is greater than the favorable, the direct material price variance. So we found out this 2,100 unfavorable came from huge failure of the management cost, cost management of the quantity efficiency variances. We purchased the cheaper price of this material, but we spent a lot of this cheap material. So we failed to use this cheap material that's significantly. So it is unfavorable. Okay, in the same way, let's calculate direct labor price the variances. So ABS price variances, how do you get it? $26, the actual rate per hour minus 25. And then times what we need is 5,775 is the labor quantity. The price variance times actual quantity. So which one is bigger, right? Actual rate is greater than the standard rate. So it is unfavorable result. And then the direct labor quantity, also calculate ABS. Then we compare this direct labor minus the standard or the labor quantity. Then which one is greater? Right, the labor in actual is greater. So it is unfavorable as well. And then we multiply the standard rate per pound 25 per hour. Yeah, here you go, 25. Standard rate per hour 25. So we got 13,125 unfavorable result as well on the labor quantity. So we can just sum these two number up. So we got the 18,900 exactly same as this, and then this 18,900 came from 5,775. The price variance is unfavorable. That means that the company hired the very expensive direct labor, but using this expensive labor, they use this expensive labor very long time, so that they pay a lot. So 18,900 that the labor cost variance came from these two inefficient quantity usage of the labor and inefficient hiring process of this labor. So we have to ask this our hiring manager, why you hired expensive. The reason why we hire the expensive labor is that they are skillful. They can finish work very in a short time. That's why I give them higher hour wages, expecting that they finish earlier, they efficiently working hard. Okay, so that's all. See you in the next video clip. Bye bye.